Good morning, everybody. I am Pirkko Juntunen. I'm a freelance journalist and writer, as well as a conference producer here at IPE, by a panel discussion on emerging markets with our event partners, American Century, Harvest Global, and UTI International. I now welcome Magnus onto our virtual stage. As I said, Magnus is the CEO of Alecta, and he hardly needs any introduction, being a veteran of the pensions industry. But in case you missed it, Magnus also won the IPE Pension Leader of the Year 2020. I'm sure that was one of the highlights of his career. Welcome back, everybody. We are now going to have a panel discussion on emerging markets. So let me introduce you to Richard Adams, who's the Senior Investment Director of American Century, and he will talk about a broad view on emerging markets debt. And then we have Praveen Jagwani, who is the CEO of UTI International, and he will focus on India today. And we also have Thomas Kwan, who is the CIO of Harvest Global, who will focus on China. So we have quite a few questions to go through and themes. So why don't we start with the first one? Some of you heard Magnus's presentation. So I would want to ask you, what is the investment case for emerging markets? So why should a Nordic investor, such as Alecta or others, consider emerging markets now in 2021 and beyond? What are the opportunities and risks or challenges? I'll start with you, Richard.
Thanks very much. Good morning, Pirkko, and good morning, everyone who's able to join today. So I think actually to build on Magnus's comment, he talked about the need to develop a deep understanding of emerging market exposures. And I think in our experience, one of the main misconceptions in emerging markets is about the relative importance of local and global factors. So obviously it is critical to understand the local factors, because emerging markets are an incredibly diverse set of countries, and each country has their own idiosyncrasies. But actually, when you look from a top-down perspective at what really drives emerging market returns, there are really three key macroeconomic variables that historically have explained 80% of returns on the debt and equity side. And so the sort of main areas that we focus on are the growth differential between emerging markets and developed markets, the level of commodity prices, and US monetary policy. And so to address each of those in turn, if we look at the growth differential between emerging markets and developed markets, I think in the very near term, the second derivative of growth at the moment favors developed markets, because what we're seeing right now is we're seeing access to vaccines is being provided at a faster rate in developed markets, and a number of countries, in particular China, is much more advanced in terms of the progress in its recovery. So that's why DM has pulled ahead, I think, in the year-to-date performance over emerging markets in the last couple of weeks. But when you look at 2021, and in fact, if you take a multi-year view, clearly there are some quite powerful structural forces that favor emerging markets in terms of the growth differential. So, for example, Chinese GDP growth is forecast to revert to a trend of around 5.5% by 2023. And China, of course, exerts an increasingly important influence on growth across emerging markets. US growth, by contrast, is forecast to revert to 2.5%. So clearly that growth differential structurally favors emerging markets. If we look at commodity prices, we see a number of reasons that they can continue to appreciate. So one is the improving demand that I spoke to, in particular from China. But actually, we've seen years of underinvestment in production capacity because commodity prices have been depressed. So capex has been significantly below historic levels. We also see structural demand from some of the themes that Magnus was talking about. So in particular, there is demand for copper and silver, which are used in green energy technologies. And we also see investors wanting to invest in commodities because of the concern about inflation. So they're allocating as a hedge. And then if we turn to monetary policy, generally speaking, it's actually the short end of yield curves that influences currency movements. So even with the spike in 10-year bond yields that we've seen recently, we've actually seen very little movement at the short end in 2-year rates. And this tells us that the market expects US short rates to stay low for a protracted period of time. And historically, that environment has favored emerging market assets. So I think the framework I described, it explains why we've seen some headwinds in the very near term, but I think it also suggests that the conditions for 2021 and coming years do favor emerging markets. And just to sort of to conclude my point, I talk quite generally about emerging market assets, but this framework is quite helpful, we think, for thinking about how much risk to allocate to emerging market debt or emerging market equity. But in particular, it's quite helpful for thinking about allocation decisions within emerging market debt. So each of duration, credit, and FX have slightly different relationships with those variables that I identified.
Right. And in terms of regions that you're thinking, or do you have a global view, or is it specific regions that you consider when you're looking at this?
So we're thinking about emerging market debt across the full asset class spectrum. So at the moment, we favor Asian currencies, but we have more exposure on the local side in Latin America because the risk reward profile is better there. So it varies a little bit by depending on which segment of emerging market debt we're looking at.
Okay, great. In terms of country allocation, so if I go to Praveen, you are the India expert here. So what is the investment case for India for now and going forward?
Thank you, Pirko. India has been demonstrating above trendline growth for many, many years. And within emerging markets, India stands out as a real engine of growth. Allow me to share a slide. So as you can see, the historic trend line of India's GDP growth, I've got to make 3 points here. Number one, the growth itself. India is the fastest growing large economy today. And according to the IMF, in 2021, India will be growing at 11.5%. India's GDP today is already bigger than France and the UK. And in the next 3 years, it'll be bigger than Germany. In the past 30 years, when India's kind of liberalized, we've seen 7 different prime ministers in India, but the average GDP growth has continued to be 6.5%. So despite changes in political scenarios, India's GDP growth just remains consistent. The second point I want to make is that the reason for the consistency of India's growth is driven by domestic consumption. And India is not an export-oriented country. So no matter what happens in the world, trade wars, real wars, taper tantrums, Brexit, the expanding young middle class of India continues to buy more bicycles, pizzas, refrigerators, and Levi's jeans. I mean, take example of cars. Car penetration in India is 2%. In China, it's 12%. In Brazil, it's 19%. In the US, it's 80%. On a low base of 2% in India, the growth potential is huge. And then as equity investors, we are all interested in growth percentages, which is where a country like India, where 65% of the population is below the age 35, continues to consume. And everyone knows youth equals consumption. So that's the second point. And finally, the reforms of the past few years. We have seen a raft of structural reforms like the goods and service tax, insolvency bankruptcy code, the agricultural reforms. These are very destabilizing reforms in the short run because they are aimed at structural changes to the economy. But in the long run, they build the foundation for rapid growth. And the full impact of these reforms is not yet visible in the equity markets. So 3 points. Again, number one, India is the fastest growing large economy in the world today. 2, this growth is very predictable and dependable because it comes from domestic consumption of a young middle class. And 3, the full impact of the reforms is not yet visible in the equity markets.
Right, great. So if we move on to the other Asian giant, China, Thomas, so what is the investment case for China, would you say?
Yeah, I think beside all this macro backdrop that Richard had mentioned, I think there's one big trend or one big theme that not many investors notice. Remember, at the end of last year, China, Japan, and Korea we both announced the carbon neutral target. That actually would bring to a large amount of investment in China in the next 5 years. And also, as the world is doing it together, many of the product related to new energy as well as EV, China actually is leading in that a winner. Maybe I share some slide here. Okay. So, for example, I think especially if we're talking about in the solar supply chain, um, battery, we are actually in terms of market share at the moment, we are actually in the leading position. Um, in China, I think around the world, for example, the installed solar capacity in China is about 40% of the world. Wind power, 37% of the world. So it means that I think compared to many of our competitors, we do have an absolute advantage in terms of not only investing that within our country, but exporting that. But if you take a look at another number, the Chinese government actually announced that for the next 40 years, we'll be spending over 139 trillion yen in green infrastructure. If you just simply divide it by about 40 years, it means 3.5 trillion of RMB that will be spent on green infrastructure. But I'm sure in the next 10 years, the amount will be much more than that. So that actually, I think, and together with the United States as well, US also announced that they will actually to upgrade their infrastructure, especially in terms of green infrastructure. So I think in the next 10 years, we'll be seeing a boom in green infrastructure, not only in China and the States, but around the world. The question is, who actually is the leader in that? That actually will be very important to select the investment market that you want to invest in. On top of that, I think if we go back into the China specifically, although they announced that target to achieve carbon emission peak and carbon neutral is 2030 and 2060, but that actually is the target for the latest achievement date, meaning that we actually want to achieve that in earlier days. And the internal, I think, the guideline is to try to work towards a carbon emission peak of 2025 and carbon neutral by 2050. So what about, think about it, in the next 5 years, China will need to manage such a large change that actually will require a lot of infrastructure investment, as well as for all these individual companies in different sectors, like for example, their process upgrade, etc. That will also require a lot of investment. So on the electrical vehicle, the EV cells side, we are actually looking at least 35% growth per annum over the next 5 years. Solar, wind power, we're talking about mid-teens kind of growth. That's actually only talking about the local installation. That has not taken into account the potential demand from outside China.
Great. So we've touched a bit on the macro backdrop already, but it is often viewed as more important when it comes to emerging markets. And how do you approach or deal with issues such as political tensions, whether it's domestic or international, such as trade wars and China, US? And what does a decoupling of the US and China mean for emerging markets, as well as currency volatility or central bank stimulus packages? It's a lot of questions there, but also inflationary fears. What does that higher inflation mean for emerging markets? I'll start off with Richard again, since you have a broad view on global emerging markets.
Sure, thank you, Pico. So I think two of the key macro issues that we hear investors talking about are, one, concerns about inflation, and two, also concerns about the sort of long-term implications of the policy responses to COVID-19. And I think if we look at the inflation picture in emerging markets, it is quite mixed. In general, inflation has picked up in emerging markets in the last couple of quarters, and some countries are seeing forecast inflation running above trend. So Turkey and Brazil would be two examples. But actually, what we're seeing is the momentum of inflation is declining in many countries, and many countries are actually expected to undershoot their inflation targets this year. That would be true for South Africa and China notably as well. So I think overall the inflationary risk in emerging markets is contained, and of course we haven't seen monetary expansion on anywhere near the same scale as developed markets. But to sort of get back to my theme of the need to, excuse me, to look at local and global, the global picture as well. If we look at the sort of global setting, then I think it's actually the developed market policy responses that are most important for thinking about emerging market assets. So if we look at the US, you look at the sum of the twin deficits, that has risen from 6% of GDP a year ago to nearly 20% of GDP. And historically, a large twin deficit has caused the dollar to depreciate. We see the same thing if we look at the money supply. So the year-on-year growth in the M2 measure of money, for example, so if we went back to 2009, looked at the monetary stimulus then, M2 growth was about 9%. This year, it's 26%. So that tells you that the monetary stimulus that we're seeing now actually dwarfs the stimulus that we saw in the global financial crisis. And you have to go back to the Second World War to find monetary stimulus on a similar scale. So there are some quite powerful structural settings, I think, that should cause the dollar to depreciate. And generally speaking, that is pretty favorable for emerging market assets, in particular emerging market currencies. And so one of the sort of big rebalancings we expect to see in terms of implications is that at the moment, investors have much more allocated on the external side of emerging market debt than they do on the local side. The reason being that over the last decade, external debt outperformed local with lower volatility as well. But what we think is that we'll probably see a picture more like the 2000s, when local actually outperformed external debt by 3% per annum. So we think there's some quite important shifts, not just in terms of the case for emerging markets, but also in terms of allocation shifts within the universe.
Right, and do you think that going forward, the local will outperform for the foreseeable future, or is it what sort of time frame were you thinking?
Sure. So generally speaking, the dollar cycles tend to run in around 7 to 10 years. And so actually it fitted quite neatly in the 2000s with a period of EM outperformance and dollar depreciation. And then 2010 was almost perfectly the turning point. So last year, actually, we saw EM currencies appreciate quite significantly. So generally speaking, those cycles run in about 7 to 10 year cycles. So exactly, we expect to see a protracted period of EMFX appreciation. So not just for 2021, but several years beyond is our expectation.
All right, thank you, Richard. So if I go to you now, Thomas, and the macro backdrop on China and these concerns that a lot of investors have voiced.
I think on the macro side, we are actually surprisingly, I would say, since early last year, I think China not only managed the COVID situation very well, but also the macro situation. I think inflation is actually still very well contained at the moment. If you look at growth, I think domestic consumption side was much more robust than we thought. If you look at retail sales, especially online sales, has been growing. More importantly, I think this year, I think we'll actually get the spillover from the US 1.9 trillion fiscal spending. So I think both external environment, domestic environment, as well as policy environment is actually working very well for China for the time being. But on the other hand, I think what we also have to accept the fact is that political tensions, both globally and locally, is increasing. So if we take it from another angle, how can company try to fend off this risk? What do they need to do? Because a lot of these are unexpected. If we go back into the frame that the earlier speaker spoke about, ESG, I think ESG analysis would become an even more important element in your investment research now than ever. Not only because the Europeans investor demanded for it, but the kind of risk that we are facing, we do require that. Because, for example, a lot of the incidents, when political tension is high, a lot of the incidents that happen to companies, especially EM companies, are related to governance, social responsibility, and especially now, with everyone in the world focusing on cutting down carbon emission, environmental management is also very important. So I think right now, with all this uncertainty, especially in China, regulator has already been tightening up on environmental regulations, and that's actually a way as well around the world is looking at that. I think very important for Chinese company to increase or enhance their ESG standard or performance.
Great. And we seem to be getting a lot of questions on China, but I will leave them for the end. I'll go to you, Praveen, and your view from India.
Sure. I'd like to share a slide. And while I get the permission, I find myself disagreeing with the perspective put forth by Richard, because using cues from the developed markets to make decisions on emerging markets, it hasn't always worked, particularly in the case of India. And I mean, it's like judging a book by its cover, and we believe that it doesn't always work. Sometimes it does, but doesn't always. As you can see from this screen, there are 3 lines there. There's a blue and green, which is MSCI Emerging Markets and MSCI India. And the orange line is our fund. And if you look at all the time frames, you can see that there's been a consistent and in fact significant outperformance consistently. Even if you look at 10 years, you've seen in this 10-year period, trade wars, every kind of risk on, risk off environment and volatility and macro environments that have changed, yet the performance of India seems to be very, very consistent, because we favor the micro over the macro. And picking right stocks makes all the difference, because India is truly a growth market. And I have to say, in the last 10 years, global investors have got India right only 2 times. So they have missed out on the stellar returns that India had to offer, simply because the decision point for investing in India came from stimulus of the developed market economies. So the core message is that a growth market like India is inefficient by design, and therefore it's ideal for stock picking. The opportunity to generate alpha is huge if you follow a consistent strategy. And for example, in our portfolio, we hold stocks for 5 to 7 years on average. And you could put any good local manager with local presence and you'll do well, not just us.
Right. Richard, any comments on that, judging a book by its cover?
Yeah, no, thanks very much. I love a good debate in the morning. So thank you for your comments, Praveen. I think maybe the distinction I draw is that when we think about emerging markets, we think it's important to think about both the global and the local factors. And in particular, I think where the distinction maybe in the way we're talking about it comes in is thinking about the difference between the total return and the excess return. So the framework that I described historically has explained around 70% of the direction of the Indian equity market. But I think what you were speaking to was excess returns. And I totally agree that you don't necessarily need to fixate on macro to look at excess returns within the equity market, because of course there are a number of themes that you've called out. So I think the distinction would be that we do think about excess returns, but we're also thinking from a total return perspective. We're also thinking about the direction of the beta, if you like. And I think you were focusing maybe more on the excess return.
Great. Yeah. So let's continue. I know Thomas already mentioned ESG, and obviously Magnus talked about that too. So what has your experience been on implementing ESG in emerging markets? And in particular, how can you alleviate investor fears or concerns about ESG in emerging markets? Maybe I'll go to Praveen here on India.
Now, ESG is a very simple idea, but very complex application. In principle, nearly the entire world is aligned to reduce carbon footprint and create sustainable businesses and communities. In practice, the world of money is murky, as we know, and with a lot of greenwashing going on. I mean, if you look at with a name like Greensill, you would have thought they would be a very ESG-friendly firm. Now, India is a signatory to the Paris Accord. We are aiming for a net zero by 2050. And when 26% of the country is struggling to find 3 meals a day, ESG and climate change are slightly lower in priority. I mean, they feel like first world luxuries. So realistically, while India is making great strides in this direction, I would say expect slow progress. At UTI, we see as a leader in India, we see our role to teach and guide listed companies rather than act like a judge and executioner. So we have been signatories to UNPRI since 2016, and we believe in teaching companies how to improve their ESG status. So we are training our investment teams to engage actively with the companies and to educate them consistently about how to be more sustainable. In private markets business, we actually measure the ESG improvement we make in our investee companies. We have developed a ESG measurement tool by synthesizing the IFC and CDC norms, and we conduct ESG audits each year to verify the impact and progress our investee companies are making. This is really path-breaking for a country like India. And as an example, when we conduct an ESG audit on a school or a college we invest in, and let's say it scores 45 out of 100, we tell them in order to qualify for the loan from our private credit fund, they must improve their ESG score to 60. Even before we have lent them a single rupee, we make them an improved version of themselves. And then we require the company to improve their ESG score every year by 5 points, or the interest rate goes up by 50 basis points. So through this combination of carrot and stick, we are pulling the country and the companies towards a sustainable future.
Great. Yes, and obviously that is a great concern, as you mentioned, when getting 3 meals a day is not taken for granted. ESG issues does seem far-fetched and maybe far away, but as you said, there's much improvements and strides made in India and elsewhere. How is it in China, Thomas?
I think the topic ESG has been under the spotlight since a couple of years ago. I think there's a lot of opportunity, as I actually mentioned earlier, to incorporate ESG into your investment analysis. But the key issue is how. Which framework are you going to use? Where are you going to get the data? I think the mainstream methodology is to adopt a global framework and using data from one of the global data sources. But the problem is that in China, as in many EM countries, the stage of development and the ESG issues that are important to this company varies and also very different compared to the developed world. So simply speaking, if you use the developed world framework to look at ESG issues in China, very likely most of the time you will not be able to pick up the material issue from there. So what we do in China is that we actually start from scratch. We developed our own ESG analytic framework for Chinese companies. And more than that, we also compile our own data set because in China, as in many EM countries, most of the companies don't actually disclose ESG data. Even if they have ESG disclosure, the standard varies, right? So maybe I'll just put up one slide here first.
Oh.
Okay. Can you let me share the screen? Yeah. I think one key question that many investors have, or they always ask is, would ESG add value to investment? So simply looking at the MSCI ESG index versus the broad market index. In the developed world, US, Europe, ESG doesn't add value. But if you look at the EM world, China in particular, actually you can find strong alpha from it. But the problem is for example, when we look at the China here, we're talking about all China, including Asia. But many data providers, they have not been able to look at the domestic Chinese company, China A share company, because disclosure requirements are different. Also because of the language barrier, they have not been able to effectively evaluate Chinese company, domestic company. So again, we also developed using our own data. We actually constructed an index together with CSI. That actually have proven that in the last few years, ESG factors alone has been able to drive around 5% of outperformance. So I think the key issue is here is how you look at that. And secondly, definitely, I think another challenge is when it's come to implementation. How are you going to do that? Because I think not only in developing market, in many of the developed world, the implementation part is more art than science. So we also try to take a more systemic approach using our data and framework. So for example, if companies that are weighted as a bottom, we have certain rules to not able to invest in that. Try to make it more systematic so that we can extract more value from that.
Richard, any comments on ESG in emerging markets broadly?
Yeah, thanks very much. So I think Praveen and Thomas spoke very well to corporate ESG. So I can share some reflections on the sovereign side. And one of the things I'd say is that I think that ESG is possibly more innate to sovereign analysis than it is to corporate analysis, because in particular, social and governance factors are absolutely central to the analysis of sovereign debt. So historically, the quality of institutions has actually had the strongest influence on long-run spread levels. So countries with a strong track record of adhering to their monetary and fiscal policy targets and of navigating shocks tend to have the lowest borrowing costs. Chile would be a good example of this. It's a country with a very high governance score, scores well in terms of rule of law, controlling corruption, and has some of the tightest credit spreads in emerging markets. Interestingly, social factors are very highly correlated with governance factors on the sovereign side of emerging market debt. And there is a causal relationship, and that link is really due to the fact that countries with very high income inequality, you tend to see a lot of policy pressure in terms of the spending that is required to address social issues, but that can often negatively influence the ability to repay debt. And we see the same thing with countries that have very poor health or education systems. When you look at environmental factors in emerging markets, they tend to be more independent of social and governance conditions, but they can still have quite a material bearing on the ability of issuers to repay debt. So one current example would be Argentina, which has just been experiencing a drought in the north of the country. And as a result, agricultural output is expected to fall by around 7% this year. So that obviously has a knock-on effect in terms of Argentina's ability to earn dollars through exports and therefore service its external repayments. One thing I would say to agree with Praveen, he sort of talked about, I guess, the how much attention should you pay to environmental factors, for example. One of the things we try to do is we apply different weights to different regions. So, for example, we don't think it's right to penalize frontier markets for poor environmental factors in the same way it would be to punish a larger emerging market or developed market economy. Usually they tend to be countries that are smaller, so their total carbon emissions are smaller, and obviously they are earlier in their development stage. So if anything, the social factors are more likely to be the priority. So I would echo what Praveen said on that front.
Okay, great. And now we're coming to a question that is sort of unavoidable in 2020, 2021, and it's of course the dreaded COVID-19. Richard, you had mentioned policy and what policy responses mean for emerging markets, and also how has your firm handled it so far in terms of working from home or lack of face-to-face meetings, but also on investments? How there are obvious winners and losers, but how has it affected, if at all, your asset allocation in terms of industry and sector? Maybe I'll continue with you, Richard, here, and then go on to Thomas after that.
Sure, absolutely. So to address the sort of first of your questions about the impact on the asset class, if we look at emerging market debt, then obviously we need to look at the implications of COVID-19, in particular the local policy responses. One of the probably most stark examples would be Brazil. So the policy response of the Bolsonaro administration has been slower than we've seen in other countries, and that has brought some pressure to change direction in terms of economic policies, liberalization, and also it's brought pressure to increase fiscal spending at a time when Brazil really needs to focus on cutting its deficit. So certainly we've seen some quite important implications within individual countries. As I mentioned, I think one of the sort of most important factors is the accumulation of debt in developed markets, which Magnus spoke to earlier, and the monetary policy responses that go alongside with that. So that has more of an influence, let's say, on the direction of markets. And just to clarify there, I think absolutely it's important to look at these local factors to understand each country deeply and to generate excess return. But generally speaking, we think a safety first approach is most appropriate for emerging markets because it is a volatile asset class. So I think capital protection first is generally quite an effective way to address it. Just to sort of comment more locally on COVID, I have to say, as you might be able to tell, the biggest impact it's had on me is lack of access to getting a haircut, which I've been denied for the last 3 months. But if that's the biggest of my concerns, then obviously I've been very fortunate. In terms of the impact on American Century, we've invested a lot in technology, so we had a very smooth transition to working from home. If anything, we used it as an opportunity to increase transparency and access to our investment teams. So I think that's something that our clients have very much appreciated. And maybe if I can just make one comment, actually, if it's not too inappropriate, about American Century, but one of the unique elements is that we're actually owned by a medical research institute. So one of the things the company's done a great job of is actually making a lot of medical information available, and we've got some great content that's provided by the research institute on, for example, the science behind vaccines, which wasn't something that I was so familiar with before. So I think it's a test that we've been through, but overall I think it's actually strengthened our business.
Thomas, your views and on China and also Harvest Global, how have you been doing?
Well, yeah, I think China actually, especially at the early stage of the COVID-19, has the strictest social distancing rules compared to many countries. So we would have thought that actually that would have bigger impact on the economy. But indeed, I think China, in terms of online shopping, the penetration of online shopping, actually has been leading the world even before COVID-19. So last year, we've seen many of these companies actually see their revenue grow by more than 30%, because many of the Chinese companies are well prepared for a virtual world. Like, for example, look at companies like JD's, Meituan, all these companies, their share price actually has been doing very well. And also internet content payers that are also doing very well, like Tencent, Bilibili. So I think China also, I think, have the luck that we have many people have already lived in a semi-virtual world before the COVID. So that's why I think that actually will, I think the after COVID, as many actually expect, people behavior will change. So meaning that I think we really have to be mindful that many of these old business model would not come back.
Okay. And finally from you, Praveen. You're on mute, I believe.
I'd like to share a slide, please. I think there are two aspects to India's COVID story. First is the pandemic itself, which has not been as horrific as originally feared. In terms of deaths per million, India is ranked 84th in the world. And countries like UK, US, Italy, Spain have had much more tragic outcomes. And I was sorry to hear even about Sweden from Magnus earlier. So as you can see, the numbers have really tapered off. And while this is data released by the Indian government, which we take with a pinch of salt, but directionally, the shape of the curves are right. And we think that the second wave hasn't come, it won't. And all the extra emergency measures that the government hospitals have taken in terms of wards and ventilators, all that has now been dismantled. So 65% of India's population is rural. So some of this is intuitive, why the outcome in India was so benign. You know, rural population doesn't eat any processed food. They live close to the earth and therefore are exposed to the elements and microbes. As a result, they seem to have far better immunity than people like me, urban dwellers who live in air-conditioned environments. So India has been able to bounce back extremely strongly from last year. Like they say, never let a good crisis go waste. So India has actually bucked the trend and is doing really well in terms of domestic air travel. Its consumption metrics are above pre-COVID levels. Digital transactions are 400% up over 2019. Restaurants and hotels are buzzing again, and business confidence numbers of last month are higher than even pre-COVID levels. So that's sort of one part of the pandemic. The second aspect of COVID is that India is the manufacturer of 65% of world's vaccines, and already 30 million people have been vaccinated, which is roughly the entire population of Nordics. And not only are we vaccinating the domestic population, we are taking steps to boost manufacturing for export. And we have been donating vaccines to, as of now, more than 15 countries in the Caribbean, Africa, and Latin America. So the story is quite positive for the moment after a horrible year.
Great. We are running out of time, but I will squeeze in a question from the audience. It's directed to you, Praveen. Are Indian or emerging markets companies generally receptive to ESG? Don't they see it as an obstacle to growth or a Western imposition? Sort of as you mentioned that if you're you can't feed yourself, this is maybe not on top of the agenda. A short answer, please.
Yes, there's a minority that is not woke, but the vast majority is completely aligned. They see it as a risk mitigation for sustainability of the business in long term, because we as asset managers are starting to choke funding to companies that don't align themselves with the goals of stewardship and sustainability.
Great. And I have a quick question for Thomas as well. It's from the audience, from my colleague Liam Kennedy and also Richard Niganda. The first one is that the economic potential of China is obvious, but the aging population is a worry. Could you comment on that?
Well, I think the simple answer to that is that first, if you look at the urbanization rate, we are actually at 60% at the moment. So the 14th five-year plan has a target to increase that to 65%. So meaning that when compared with the director, well, we have another 10 to 15% of urbanization power, which actually will expand the consumption power. Secondly, talking about equality, we have more women that can come to the labor force as well. So I think if you add the two forces together, I don't think aging is the problem.
Okay, thank you very much. And I'm afraid we have run out of time. So thank you very much, Thomas, Praveen, and Richard for this debate. I hope you can stay on and tune in again at 9:40, only a couple of minutes away, when we will hear from Sony Kapoor.